Well, what a day today was. We saw volatility across the board, and the ag markets, the livestock and grains markets were not spared. So let's talk about some of the livestock. Let's go to lean hogs. Look, if you're looking for some news, we're not really getting that much news. It's still all about China, but we have to kind of look at technicals when we don't get anything really fundamental to look at. And I think that if you're a bull, the line in the sand is still that 88-cent level. The July 88-cent level is going to be some decent support. Keep that in your mind. That's going to be something that we really have to pay attention to. Also, I think it's still a binary event, and they're so difficult. These things are so difficult to trade because either we're going to have the trade war, or we're not going to have the trade war. President Trump wins or he doesn't win, and at the end of the day, he hasn't said what he wanted. So whatever happens, he'll probably win because he'll say that this is what I wanted all along. But number two is this: the market, especially the equity markets. This is where they all kind of fit together here. Every day that goes on, and every day we've got a problem with China or some sort of trade war, quote unquote, with China, we run the risk of losing that customer coming back to us, right? Because China's going elsewhere for whatever they need, whether it be hogs or soybeans or whatever, and they're going to go someplace else. And every day that they're shopping elsewhere gives that new purveyor of goods a chance to lock them down as a long-term customer. And I think that's what the equity markets told us here today. So keep that in mind. Is the customer going to come back? And that customer being China. That's something that I think the equity markets finally woke up to. So China as our biggest customer, each day that this goes on, it makes it more difficult for us to get 100% of it back. We'll get a lot of it back, but we're not going to get 100% of it back. And lastly, if you still kind of take a long-term view, we've had a 6-cent trading range in that still, and we're back in the middle of it again, right? But it's some big gyrations there, big swings, and I think that now is when we're going to have to start looking as that $88 level, 88-cent level I spoke about earlier, going to be the line in the sand for the bulls. But B, don't get too caught up with the dollar. Yes, I mean it made a yearly high today. But if you go back 3 or 4 years, we're still in the middle of a big trading range, right in the middle. So we've got basically hogs in the middle of their trading range as of late. We've got the dollar in the middle of its trading range if you go back 3 or 4 years. So we're going to have to be looking. This is kind of wound up to be a place where both of those could break out, and the dollar could be a headwind as we go up to these new highs. Granted, today was a new yearly high, but we still are in the middle of a big range if you go back 3 or 4 years. So keep all that in mind. It's going to be difficult to trade. The volatility is definitely still there, but just be careful and keep your levels in there and try not to get tied up in a lot of the hullabaloo. I'm Scott Shellady here in the CME Group floors.